Thank you very much, and thank you for inviting me again this year. After last year, I did more of a beginner's crypto tax talk. This year, I thought I'll go a little bit more advanced. Let's do a quick check-in. Is everybody here tax-based Germany? No. Okay, so some things might not be applicable for you. Just be aware of that. And who does everyone speak German? No. Okay, then we stick with English. All good. I just wanted to make sure, because with tax wording, it's sometimes more complicated to do it in English rather than just stay in German. So yeah. In the next 25 minutes, we'll go through saving taxes during a crypto bull run, because there are some strategies that you can just use. I'll talk a little bit about the biggest risks in crypto taxes. And actually, since I handed in the slides, there is another one that came. So I will actually choose a different one, but I think that one is the more relevant one for this group. And I'll also talk a little bit about cashing out crypto. I think that's also quite relevant at this point. And with all the current regulations going on, something we should talk about. And there is just some things that it's good to be aware of. And it will make your journey in crypto much smoother and easier. Because most of the time dealing with questions from authorities, and be it banks or the state offices or tax office, is rather painful, and therefore it's good to plan ahead and be just prepared so you don't have to deal with that. A couple of words about me. So I studied tax law. I used to work for the tax office in Munich, actually, not that far from here, for 8 years, and I was developing the internal software for the tax offices. So I pretty quickly swapped into the computer science department of the tax office. Then I realized that this is much more interesting for me, and I did my degree in computer science at the LMU in Munich. And after that, after I had like 2 more stops, I started Picuna. Picuna is doing tax reporting for crypto, so we're not tax advisors. We're only doing the technical part, from on-chain and off-chain data to profit loss calculations. That's our main product. We have some other products as well. Like, for example, proof of funds reporting, but those are minor ones, and today we're only going to talk about the tax area. So we're all in the area of income tax when it comes to trading. I'm using as an example always Bitcoin, because it's just easier for me instead of swapping between coins, but it's all the same for every coin and token, so you can just assume it's just as well correct for any other coin. And in the area of income tax, so that's the tax that you as a private person need to pay for income that you generate during a calendar year. And it's usually getting complicated if you mix up the different buckets. So I like to see the different categories of tax as different pots or buckets. And we have a handful that are relevant for the area of crypto, or that we can come in touch with in the crypto space. And once you know what the categories, the buckets are, and what bucket you're in, then it's also pretty simple to know what rules is applying for these certain buckets. So most relevant probably is the privates Veräußerungsgeschäft. Okay, that's not working. So that's everything related to trading, investing. That's the bucket with the 1-year holding period that you might have heard. The next one is the other income, sonstige Einkünfte. So here we're talking about the parts of staking, lending, airdrops, everything that generates income. Then also the capital income. That's often a misconception. People always assume that this would be the main one, because crypto, we all use these capital words like generating interest and things, but we're not really in the capital income. In crypto, the only expectation is margin trading, and there is a fairly new argument that the income generated through liquidity pools is also part of the capital income. So I put it in brackets. It's currently under discussion. There is no ruling yet. Then what probably most of you already have is nicht selbstständige Arbeit, so income, salary. If this is in crypto, it of course also touches the whole crypto space. But that's not usually the case. And business activity is more here to also see what it's not, because usually if you do all of these things over a certain volume, over a certain category or intensity, then you might also be considered a business activity. By the way, I do not mind if you ask questions. So if I lose you somewhere, I really want all of you to stick with me. That's complicated, and I talk about that all day. So I sometimes get carried away. If you think you have any questions, please just raise your hand and we'll integrate it. And probably someone else in the room has the question as well. So yeah, let's look into trading. So here we need to calculate our gains, and that's already something quite unusual, because as a private person, you don't have any other aspect in your life where you need to calculate your own gains. So usually you get your salary, and the salary tax is withheld directly from your employer. You get income, and the bank withholds directly all the capital income tax for you. But in crypto, and that's also a big pitfall where a lot of people struggle, is you need to calculate your own gains, you need to gather all the data and do your own profit loss calculation. So that's more of what people with businesses are used to almost have like a bookkeeping process in place, because that's kind of what you need to do here for your crypto income. We are dealing with abstract goods. So one Bitcoin in my wallet is the same as any other Bitcoin in my wallet. And therefore, we need some kind of abstraction. And here we use first in, first out. First in, first out is a fictional concept. But we somehow need to have this fiction to see what's the cost basis for the assets I just sold, to calculate the profit of the asset I just sold. And the German wording is Verbrauchsreihenfolge. There is different ways to calculate that. That's the one that's most accepted in Germany. There is others that are accepted as well, but this one, if you have a tool and it has different settings, always choose first in, first out, because it also usually gives you the lowest taxable income, because it's easiest to get over the 1 year holding period. If you do last in, first out, which is accepted under some circumstances, especially if you're in the business context, then you always have like shorter, you sell the youngest coins first, so it's much harder to get over this 1 year holding period, and all your assets need to be over the 1 year holding period. If you start with the oldest one in your wallet to sell that one first, you start already having tax-free income generated once you have one asset over this 1 year holding period. And then we have another, yes.
Day X and Y, and on the blockchain it's the same. So in theory, you can say this Bitcoin was purchased on this day, time, blah blah blah, and will there come some mechanisms or some systems which can identify, okay, this is exactly the amount you purchased on this day, or not?
I disagree. It's not technically possible in all circumstances. Like, yes, with Bitcoin and their UTXO thing, it is kind of doable. And but once you start being on an exchange, that's all the same. That's like that's just a number on the screen. Like, you don't even have those. They are in custody somewhere completely different, and they just show you what you have. So there we completely lose the possibility of tracking which Bitcoin you're exactly exchanging. Yes, you can do that. You can say, I'm specifically selling this asset right now that I bought there. For the tools, it's hard to integrate that, because you need to like manually match that, which would be a lot more effort for you. And there is like no tool out there which has this functionality. You would do a workaround by like giving them custom names or rebrand them, and then you can do stuff like that. It is possible, and it's technically allowed as well, but not practical.
Okay.
Yes.
What is preventing you from saying the contract address of the DEX is yours? Like, how does the government verify that that is the address that you control?
Mm-hmm. Let's put that at the end to the question part. That's too far from where we're right now, and then I'm losing people. There is another very smart instrument in this area of calculating your profits. It's called account separation. And with account separation, you can do a lot of things that we just tried to accomplish manually. everything that can be separated must be separated. So that's the basic rule. And if you have one Bitcoin on Coinbase and one on Kraken, and you sell the one on Coinbase, of course the one on Kraken is still there because that's a different one that's not getting affected. And with account separation, and in crypto, we can create as many accounts as we want. We can create one account for each purchase, and then you have the same effect what you tried to accomplish. Just send them to a different wallet or a different address every single time. And then you can really decide which exactly purchase you want to sell right now. But even if you have not done that, you can still use account separation to do basically exactly that, because they're like, it's like a stack in there from starting from the oldest to the newest. And also when you move them, you're automatically moving the oldest. So you can say, okay, this one I'm moving here, this one I'm moving there, and this one, now the third one, that's the one that I'm selling. And therefore you have technically independent access to any single asset for calculating the cost basis. But that's something you need to know. And that's also the big part what we're going to do later in how to save taxes during the bull run. Because that's exactly the point that we want to do, where we like manually pick which assets we are selling right now and how to like smart sell and buy assets. So yeah, then there's a lot of other special cases where you generate extra income, mining, staking, lending, airdrops, forks, etc. I'm not going into details for those right now because that's the point we want to focus on right now, how to save taxes during a crypto bull run. And here I took a random bull run from the past. That's the 2017 Bitcoin chart, just because it's such a nice one. And we are assuming you have like two different kinds of assets, one that you're trading and one that you're investing. Can be the same asset, the same coin, but two different, like many people have like their holding assets and their trading assets. And trading creates a tax bill, especially during bull runs. Here you accumulate profits, and those are usually short term, and then you're ending up with a profitable tax at the end that you pay up to 42% taxes on. So that's really a quite big percentage that goes away to the tax office from the profit you created. While your investing coins probably just sit somewhere in your hardware wallet locked away and don't do anything. And that's the assets that are interesting now, because those are the ones that we're using. So imagine you've bought way back, already tax-free. For example, in 2015, you bought one Bitcoin for 200 euro that you just want to hodl and say, I want to keep that one Bitcoin. But you still sell it and you buy it back. So you sell your one Bitcoin that's right now already tax-free and buy a new one the next day. Don't do it immediately. That could be considered wash trading or something, but it's completely fine to have like a couple days in between or have not the exact same amount. Sell it, buy a new one. So now you have a new Bitcoin that's worth 12K and bought in, for example, December 2017 and has a new one-year holding period. And we all know after every peak comes another crash. Then we do the same selling and buying when the crash comes in. So we, for example, sell our now taxable one Bitcoin again a couple months later, for example, for 5,000, buy a new one the next day, and now we have a taxable loss of 7,000 euro that we now can calculate against other profits while still having one Bitcoin. So everything we paid was a little bit of transaction fee. And we have 7,000 that potentially offsets more than 3,000 euro in taxes that we are saving. But to do that correctly, it's really important to know exactly which coins am I selling right now. Do I have my account separation correctly? Do I have my first in, first out method figured out correctly? I definitely recommend using a tool if you're doing something complex like that. And keep in mind, in many tools, you can either simulate trades to see if you come to the desired outcome, or also just enter the trades manually to see if you come to the desired outcome for that. Now we're coming, yes?
How can you know which coin is going to go down?
Yeah, that was the slide from earlier, the first in, first out, and account separation, those two combined.
If your coin
So.
will continue to grow, you cannot do this. Or?
Yeah, if the time between those two is more than 1 year and it just keeps continue going up, then you lost trading fees for the chance to have something to offset from your taxes. That would be the case, yeah. So it has a little bit to do with market timing as well, knowing the market, and that your coin that you want to hold on to actually does go down at some point.
Does it make sense to sell all kind of coins we have and buy them back, or what's the strategy then to generate sales?
This is not realizing profits. This is you want to hold on to your coins, but still use them to generate losses over the time. That's not a trading strategy, so that's important to know. That's a tax strategy. I'm not making any course predictions here. That's also why I used a chart from 2017 and not a made-up one for 2025, where I'm telling you how high Bitcoin is going.
Wash trading, it's not allowed in Germany, is it?
Wash trading does not really apply for crypto right now, but there are still rules that if you do something just for the purpose of lowering your taxes, the tax office can say that they don't accept that trade, for example, and therefore it's like don't sell and buy 2 seconds later. Like wait a day, wait 2 days, swap the amount slightly, something like that, so that they're different. Yeah.
I have a question. If the coin I bought is not Bitcoin but Monero, then how can the tax authority determine that which Monero is the same as the Monero I bought?
I'm putting that question also to the end, to the question block, because that's also too far off from what we're talking about right now. I'll answer it, but later. Let's stay with the topic right now. And now we're going into the biggest crypto tax risk, and that's actually also related to what we've just seen. And that's, in my opinion, everything that generates additional income. Is it staking, DeFi activity, lending, etc.? Because here you're generating your income taxable immediately with the face value once you receive it. So, for example, you have 100,000 income during this high price time and make a lot of money with your staking, lending, DeFi, etc. So it's all basically one category. You're paying taxes for those 100,000. Then the value of the token goes down. You remember that you need to realize your losses within 1 year holding period. Otherwise, you can't tax deduct your losses at all. So you sell them within 1 year. So the staked rewards are now 10,000, and now you have a deductible tax loss over 90,000. So you might think, okay, it's all fine. But the big problem is that your 100,000 staking income is not deductible against your 90K tax loss from the trading that you made when you sold your assets. So they're not offsettable with each other. So this will still leave you with a tax bill of up to 42,000 euro for this year. And only the 90K loss can either be deducted directly against other trading if you have other profits, or later on against something else. No. There is different loss circles, which loss you can deduct against which one. It's very complicated. A lot of papers have been written about that stuff. But the trading part is like one of the very narrow ones, and you can trade against other privates Veräußerungsgeschäft income. That could be if you have something else, if you have bought a private property and you sold it with a profit or something, then you could deduct it against that. But not your salary income, not your freelance income, not any of those things.
Is there a particular reason why they're not offsetable?
They're different buckets. That's the pots that I showed at the beginning. Once you figured out what pot you're in and you know the rules for these pots, you'll see like one was this other income pot, and the other income pot is not the same as the trading pot, and therefore they're not offsettable against each other. Yeah. 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 That's exactly the problem. That's exactly what I want to show you here. So if you think you're doing really good because you're making a lot of staking income, this could backfire with this rule. Because who has, like your assets are now 10,000 and you already sold it, and the tax office wants 42,000 from you that you don't have at this time. That can have some quite negative consequences. And now I'm going to use my last couple minutes to go a quick overview over cashing out. So there is some things you might have heard about the AWV-Meldepflicht. That's not really relevant for private people. It still comes up every once in a while. MiCA, that's a really interesting one, the travel rule, because those are relevant for exchanges, but therefore they're also affecting us as investors and traders when we are sending money from a so-called unhosted wallet, like our hardware wallet, MetaMask wallet, etc., to a exchange. Then they need to get a proof of source. So they need to verify that those assets that you just sent to the exchange are actually yours. And what you can do is send a transaction over 1,000 euro, equivalent roughly, because then you can like white label addresses, and the test for a proof of source for 1,000 is much smaller and easier than for 10,000 or 100,000. And by sending one smaller amount of only 1,000 euro to an exchange, you can white label your addresses. Once they have it in their system that that's your address, they don't do any follow-up questions. And then you can send bigger amounts later. And the other thing is proof of source, proof of funds reporting. That's also something that most tools can create for you or can give you at this point. That's something you might want to have ready because a lot of banks are asking for it, and also the exchanges might already ask for it if you're depositing a bigger amount. Yeah. Feel free to take a picture of this slide. Here you can see our socials. We're quite active on LinkedIn. I'm regularly posting about everything that's going on in the crypto tax space. And I think, do we have 2 more minutes? You had one question and we had one question back there.
I think you already answered my question regarding the whitelisting one, but you
okay.
can take one question.
Then how does the tax office figure out that you trade crypto? It's fairly new, but they have their ways. At the moment, the biggest thing for them, or in the past, it was banks. So when you cashed out, they got information through the banks and got information that you got a bigger amount. So basically, the money laundering regulations were relevant. Now it's through exchanges. So they're actively reaching out to all exchanges about trading data to get lists of who has traded on Bitcoin.de. That was a really big one that went through the German media between 2015 and 17 over certain amounts. And the next big one is the so-called DAC 8 and CARF regulation. And those regulations, the crypto asset service providers, so basically every exchange that's somewhere in the OECD area, so not even, I'm only using US exchanges, they don't know anything about it, will report to their authorities, and the authorities will exchange this data with each other. So yeah, there is still ways to not get caught, but it's very hard, and it's getting harder and harder. And yeah, what I see with my clients is that more and more people are actually optimizing for regulation and taxes rather than privacy, anonymity, or max income, because at some point you do want to cash out, and it can be such a big hassle to get your money and use it at some point if you did a lot of unregulated stuff using Monero, privacy coins, and especially the anti-money laundering people, they don't like privacy coins at all. So your bank will not like if you have a lot of privacy coins in your trading history. Okay.
Thank you so much, Werner. It was a pleasure to have you. And a token of appreciation, we have this mug. You already
Thank you.
That's what I think.
I do. It's still in my house and in my shelf displayed.
And it's a new design.
I see it. Looks really good. Yeah. Nice. Love it. Thank you.
Thank you for coming. A huge round of applause.